Welcome to Subramani. This video is meant for people who are maybe 15 years away or 10 years away from their retirement. So, step number one, please accept that the biggest asset that you have is going to be your retirement box, right? I keep talking about retirement box rather than a retirement plan, because your retirement box could have a house from which you get rent, annuity, bank deposits, all put together. All that assets which you have kept for your retirement is your retirement box. That will be the biggest asset that you build in your life. And if you have to understand why, it is because some 30-40 years of your life you're going to be withdrawing only from that box. When your current income goes to nil and you have to live, you have to have a box from which you can withdraw for the next 30-40 years, however long you live. So first of all, it's the most important decision of your life. You cannot borrow for it. You cannot say I will earn and repay, so there is no question of borrowing. You have to live within the means created by you in that box called the retirement box. So step number one is to understand that it is a very big event. You and your spouse have to sit and plan for it. Many men keep saying, oh, nothing will happen and things like that. So if you are a woman watching this, make sure that your husband understands the importance of retirement planning. Step two, I've always felt that retirement planning is also about retirement envisioning, or whatever is your vision or what you think about is your retirement going to be. So think about it, plan about it, see what you're going to do, sit with your spouse and talk to her. Talk to your children. If you're 45, your children may be too young. Talk to people older than you. Keep track of one person who is 20 years older than you and one person 10 years older than you, because that will show you where they are going, right, and what mistakes they are making and what you should not make. So with that, start planning how your retirement should look, where you want to be and things like that. Start thinking, because remember, retirement is in two phases. One, when you can handle things on your own, say from 60 to 75 or 80, and then one from 80 to end of life. That is the time when you might require geriatric care. Some people may not reach that stage, some people may reach that stage and not require geriatric care, but you have to be prepared for it. Just being prepared for it is enough. Those people who think about their retirement and plan their retirement and know where it is going are always happier in retirement, saying, oh, it is going as per plan, or saying, okay, it is not going as per plan and I need some of these changes to be made, right? Another important but boring thing is to track your current expenditure. See where you're spending and what you're spending. Fairly obvious that children's school fees and all those things might disappear. You may not take that many vacations, so that will also disappear. So based on all this, you have to plan how much money you will need. So by tracking your expenditure, if you have not already started doing, that's a very important first step, so that at 50, if you're spending an X amount, you can be more or less sure that at 60 you would be spending something like 2x thanks to inflation. And some expense gets replaced, right? Something else you will pay, maybe you will pay more medical insurance, you will not pay school fees. Something will happen, some changes will happen. Maybe you'll have more servants saying, I'm unable to do this work, so I require more servants. Maybe you will not have a driver, but you will start spending money on Ola and Uber, or you might start hiring a driver just for going out, right? So all those things are available. So some of your expenses characteristic might change, but largely tracking your expense now, you will also know what expenses will be there at retirement. You will be more realistic. For example, if all the petrol is being paid for by your company, you have to make a realistic assessment as to how much you will spend on petrol. You may not spend so much as you're spending now, or you may not even have a car, but you may be spending more on Uber, Ola, whatever other forms of transport, hiring a taxi, right? All those things. So something else might happen, but tracking your expenditure now is very useful. Track your net worth. See how much money you have for retirement. Your golf kit and your camera lenses don't count, and your furniture doesn't count. So all those assets which are working for you towards your retirement. So if you have an X amount today, you can be sure it will at least double by the time you are 60. and I'm assuming you will quit at 60. Maybe you want to quit at 55, whatever. You're 45 now and you want to quit at 55, whatever you want to do. If you're able to put together how much is your current expenditure and how much is your net worth, and when I'm talking of net worth, you will ignore the house, you will ignore those assets which are there just for fun, right? Those things will not be included. Like I said, no golf kit and no camera lenses. So all those things go out. So just those assets, financial assets which you are going to use for your retirement contributing assets, find out the list of those assets. That is more important than your so-called net worth, including your wife's jewelry and things like that. And when now start estimating the expenditure which you think you will require when you are retired. Do not ignore expenses which are currently being paid by the company. Maybe your medical insurance is being paid by the company. That will become your expense. Petrol will become your expense. Your telephone, which is today not a big expense, will become yours. All those expenses, your maybe monthly eating out or annual eating out or quarterly eating out, whatever. Maybe the company was treating that as a perk and allowing you to charge it as a business expense. I don't know. Very few companies would do that today, but that was a norm 30 years ago because taxation rates were high. Today no company wants to allow any such thing, but whatever you are doing, right? So account for all that and start estimating your expenses which you will require when you are retired. Right, so don't ignore any of those expenses which somebody else is currently doing, and remember that it will all be enhanced much higher. The 50-year-old pays less as insurance premium than the 60-year-old, but of course at 50 you may be paying for your parents. At 60, parents may or may not be there, or one could be one parent who is there, so you will be paying less. So estimate all that basis on currently what you are doing and what you think you will be doing. Once you do that, you know what withdrawal rate you can afford, right? So suppose you have 3 crores for your retirement corpus and you require say 10 lakhs for your expenses, 1 lakh per month, say 10 lakhs, 80,000. Something like that. So what happens is you will need to withdraw 1% of your corpus. That looks very easy, but going forward you might require more and more, right? So estimate all that, estimate inflation. You could be wrong with how long you will live, how much you will spend, how much will be inflation, what return you get. It does not matter. It is important for us to estimate and then see how far away we are from the estimate. So please make an estimate of what you have, right? You already calculated your net worth. You know how to calculate the financial net worth. Now with all that, now go and estimate your retirement income. Are you going to be working somewhere? Is it going to be zero? If it is going to be zero, then all your retirement requirements will be from the safe withdrawal that you need to do. Maybe you have a house which you have given on rent. That rental income will continue to come, or maybe you will sell that house and put it into some mutual funds or whatever you want to do. So go and sit and estimate your retirement income, because if you don't have equity shares, if you don't have a house given on rent, etc., your all your requirement will have to be met by withdrawing from the mutual fund, because you have no other assets. If you have equity, you could get dividend. If you have a house, if you have a spare house, you could get rent, right? If you have money in the bank as fixed deposit, you will get interest. But if you have none of this, and then you will have to find out at what rate you can withdraw from your maybe some pension plan, maybe some direct equity, maybe some equity fund, whatever. You will create those buckets and decide from where how much to withdraw, right? So then see if there is a retirement calculator which you can access. There are many retirement calculators. Some are very scary, some are nice. So even if you want to use the American calculators, by all means do, but the numbers will have to be little subdued, because you can't say your annual expenses are 3 lakhs of rupees, right? Even that looks too high. $300,000 is not something which people spend on. So be careful and use the foreign calculators, mostly American calculators, but there are many good Indian calculators too, right? So after, with the basis of your expenses, the calculator, etc., you will know how much money you will be able to withdraw at your retirement. And please understand, your retirement could be 30-40 years. So find out how much you will have to adjust for inflation, etc., or how much you will have to save now to create a bigger corpus, right? So those are 2-3 things which you have to answer for yourself. And once you do that, you have your reasonably well calculated retirement plan in place. Then write it down, saying this is what you have, this is what you will do. Sit with your spouse, explain, sit with your children, explain if your children are old enough, and then ask them to pick holes in that. If you have made mistakes, you will know, and ask your wife what kind of other expenses which you have missed out, right? So once you do all this, you have your retirement plan in place. Voila, congratulations. Thank you.